I suspect we're headed for a commodity bull market, which these things tend to last, 4, 5, 6 years, sometimes longer.
Joe, Steve, you've had an extra day off. Are you ready to go today?
Absolutely.
Sure.
Boy, that was enthusiasm if I ever saw it.
I was wondering why that weekend didn't last another day.
We'll try it next time. Hey, something that I want to talk about today. In looking at your commentary this week, Joe, you're talking about a lot of the precious metals and commodities. And it was interesting to me, you made some indications that there may be some investment opportunities that have been flying under the radar in that commodity section.
Well, yeah, I started off by saying that the old saying in the commodities market is the cure for high prices is high prices, the cure for low prices is low prices. And we've got some things that have been really kind of dead for a long time. Platinum and palladium in particular, those things have been in bear markets that measure in years. But if you look at the commodity indexes, I think what's interesting is that we really kind of started this bull market in 2020, if you measure from the low. But almost all the gains happened in the first 2 years because you got this surge in commodities after Russia invaded Ukraine. And so that took us to a peak that's taken 2 years. We've just been going sideways, or almost 3 years, actually. We've been just going sideways. But there are some things like that, like platinum and palladium, that have been down for a long time that are now finally starting to move. But what I find interesting is that I think that, and maybe this is related to, maybe this is what we see with consumer confidence this morning. Consumer confidence jumped big time in this latest reading, up from 86 to 98. Uh, People do not expect, or people are not acting like there's going to be a recession. And I think a lot of the industrial type commodities have been kind of dead because people are worried about the economy, the global economy, with the tariffs and all these other things going on. But the market is telling us that that is not really the concern here. The market is not telling us, not giving us recession signals. And so, one of the things that's interesting in our work and looking at history, we look at in a falling dollar environment, which we are in a short-term downtrend on the dollar, which I think is going to continue, and I'm going to continue with that until I'm proven different. But in a falling dollar environment, it depends on what's going on with the economy as to which commodities work best. So if you're in a weak economy where maybe rates are falling and the dollar is falling, then you want to own gold, and that would be the normal thing. And by the way, gold obviously is in a bull market now. It's been in a bull market for a while. And I think that is because the economy has been, or people have been concerned about the economy all this time, and interest rates haven't been that onerous. But if you start to move interest rates higher and the economy starts to pick up again, I don't know that gold is necessarily the place to be. And you want to look at some of these other more industrial things. And we look at copper. Copper's up 20% in a couple of weeks. The copper to gold ratio, which is everybody looks at the copper to gold ratio to get a feel for how the economy is doing. When the copper to gold ratio is going up and copper's outperforming, that's an indication the economy is better. But that hasn't worked that well the last few years. But copper is starting to surge, platinum and palladium starting to surge. We're seeing not as much in the agricultural side, but even soybeans and wheat are down a bunch. So my point is that old saying about low prices cure low prices is starting to work. We've had a copper production has not been expanded, and we're seeing a lot of demand for copper because of electrification. Think about that. So I think there's just some unique things going on right now. And I suspect we're headed for a commodity bull market, which these things tend to last, 4, 5, 6 years, sometimes longer. So if that's where we're headed, it's kind of interesting because you're going to have opportunities in stocks because of owning the miners and owning the companies that do these things, companies like BHP or Anglo American, things like that. But you're also going to have opportunities in the commodities themselves, and you can buy ETFs for those things. You don't have to be buying futures. So I think the key is still the dollar. We want the dollar to stay down if you're going to be a commodity bull. And by the way, commodity bull market and a weak dollar is not necessarily great news about the U.S. economy. But it's not our job to make policy. We got to work in the world we live in, and this is the world we seems to be evolving here. And so that's what we'll do. We'll invest accordingly. So yeah, it's just I just think it's something that has been kind of dead for a long time. Listen, commodity, you look at the commodity index, the Goldman Sachs commodity index. Well, it's not called Goldman Sachs anymore. It's the S&P GSCI. But that thing is down from 11,000 to 3,600 or something like that since it peaked way back after 2008. So it's just been dead for a long time. Having money in commodities has been dead money for over a decade. So I think it's time, and it looks like it's starting to happen.
You know, Steve, it seems to me that we have been so laser focused over the years or been conditioned to look at stocks and bonds. And I know, Joe, you said, you know, there are stocks involved in mining and that sort of thing, but people aren't looking under the hood. And so there is this possibility in precious metals that a lot of people are going to miss, I think.
Yeah, I 100% agree with that on the retail side. On the institutional side, most large institutional investors, whether it's family wealth offices, pension fund, they're going to have these allocations just because it's pretty much standard professional practice. But on the retail side, a lot of individuals, yeah, they could really miss out on this. For quite a while, running U.S. stocks, bonds has been a portfolio that's worked great. But there's a lot of reasons why we think that may not be the case going forward, where valuations have gone for U.S. stocks, that we think we're in a secular rising interest rate environment rather than a secularly falling one, that we think that there's really some higher structural inflation in the system, something that the Fed seems to have suddenly become aware of as soon as they could blame it on tariffs rather than their own actions. Lots of things that we think might be tilting this to where if retail investors are not running a diversified portfolio, not having real asset exposure, that they really actually could do some long-term damage to themselves if some of these changes really get traction going for themselves. Uh, I would also say that there's an element of KISS in this, keep it simple, stupid. Joe pointed to, we think we're in a falling dollar that tends to be good for commodities, good for real assets. Uh, I think you kind of want to have a focus on that. And then within that, man, there's a lot of noise. And it's going to be a challenge to separate the noise from information. But we've got noise about supply chain disruptions, less globalization. We've got, China faltering. Is that going to be bad for commodities? We've got the idea that AI is going to be consuming tons of energy, that we're going to bring reshore manufacturing, but have to do automation, that it's going to be the age of the robots. That we're going to be having EVs. We're not going to be having EVs. We're going to have hybrids, internal combustion. I would say within all that noise, this is one of the places where technicals actually can be pretty useful in that you pay attention to what the markets are actually doing. You pay attention to breakouts and whatnot. And I think that's all important, that we're starting to see some movements in the price action here, that kind of does go along with you may be seeing a multi-year bull market emerging. So for all these reasons, I think that if you're a professional investor, or if you should be having your account managed by professionals that are paying attention to these markets, because I think the next 10 years, where you kind of ignore this to a degree, are not going to be the next 10 years that we're living through.
You know, Joe, one of the things that makes us different as managers is that we always have an allocation to commodities. So with the
Yeah.
things that you're seeing, and not giving away the secrets here, but what do you think? Well, what are we looking at in terms of these precious metals?
Well, first of all, I wouldn't say precious metals. I would just say commodities because there's a lot of things going on there. Platinum and palladium are considered precious metals, but they have industrial uses too, as does gold, I suppose. Anyway, I think that you're right. We do always have commodities. It hasn't been a great thing for us over the last, 10, 15 years. We always have commodities in our portfolio because we don't know when these things are going to happen, when you're going to get these surges and so forth. But it's interesting when you look at the commodity indexes, it hasn't really moved this year. I think it's down a fraction of a percent. Why? It's all about energy. GSCI is dominated by energy, oil and crude oil and natural gas, and those things are both down on the year. But I would say, I think it's very interesting, and this is, comes from 30 plus years of experience here. We had this new announcement from OPEC Plus that they're going to increase production again, I think come July. And the market didn't sell off on that. And to me, that's a really big hint about where we are. Um, I've always taught many, many years ago, if you've got a stock in a downtrend, just take that as an example, and it applies to anything, but just say a stock. You got a stock in a downtrend because there's bad news, whatever it is, and you get more bad news and it doesn't go down. Even better, if you get bad news and it goes up, what it tells you is that everybody wanted to sell this thing, they're out. And it's time to start looking at buying. And the same thing applies to these commodities. We got bad news on crude oil. It didn't go down. Now it's down. Of course, I'm talking about it, so it's down $1 today. But in general, you got that announcement. It didn't go down, and I thought, well, that's kind of interesting. And I will tell you, I think it looks like shale production in the United States is peaking. 60 something dollar a barrel oil does not work in the shale patch these days. And these shale oil wells, we knew that these shale patches, they have a finite life here. These things are not like drilling a regular oil well. They fall off, the production falls off very quickly after you drill and start pumping. And we knew that this was going to come to an end at some point. And I got to tell you, if you take U.S. production down from here, the world's going to have a supply problem in energy. And I think actually that the biggest potential upside is maybe in natural gas. And the reason I say that is because if you go back and look 10, 15 years ago, a lot of these terminals that we're using now to send LNG out, they were actually originally built as ways to import LNG. Why? Because we were facing a shortage of natural gas until the shale revolution came along. The U.S. actually didn't have enough natural gas. We thought we were going to have to import it. So we built these LNG import plants, and ultimately we end up with the shale revolution. We had a flood of gas, and now we're exporting it. Well, we're exporting it. We've also shut down, because of environmental rules, we've shut down almost all of our coal production, not all of it, but a lot of our coal production. And new plants coming online are overwhelmingly natural gas plants. And we're getting this increase in demand on the electricity side for a variety of reasons. And so it seems to me that if you get a situation where shale production falls, because remember, the natural gas in a lot of ways is just a byproduct of drilling for oil. If you start to really bring in shale oil production, you're going to bring in natural gas production too. And I got to tell you, we could end up in a situation where we're wondering, where U.S. consumers are saying, why the hell are we exporting this stuff? We need it here. So I think there's the potential upside there. People don't understand, I think, natural gas market goes through these periods. We've seen natural gas at $15 a foot. We're trading at 3 and change right now. It's traded at 15 before, and that wasn't that long ago. So I don't know. There's some things like that, and platinum and palladium again. Platinum used to trade at a premium to gold. Price of platinum traditionally was higher than gold. Well, now it's 1,050 or whatever the number is, and gold's over 3,000. I'm not saying those things are going to equalize again, but platinum is definitely undervalued here. Platinum and palladium both have been in a supply deficit for 3 years now. They've been using more than they're producing. There's a lot of different places like that in the commodity complex where you look at the fundamentals and the supply demand picture looks pretty positive for prices if you're a producer. So look, I don't know that there's a best thing, Bob, I guess is what I'm getting at. There are a lot of things out there you can look at. Uranium's another one. Listen, GE Vernova, stock we own, by the way, GE Vernova is out there with these modular reactor designs. They're looking to plant these things all over the developed world. These modular reactors, they can plant them and do it pretty damn quick. Maybe uranium demand is going to continue to go up. There's a lot of things out there like that. So I would just say, like Steve said, concentrate on the fact that the dollar's going down. That tends to be positive for commodities, and do something general. Buy the index. These oil and natural gas prices are not going to keep going down, I don't think. And if that starts to turn, the indexes will turn up too. So I don't know. Like I said, I don't really have a favorite right now. I'm looking at natural gas and palladium and platinum. Those are the 3 things I think maybe have the most upside.
Well, you've heard Joe and Steve talk about it today, so you know there are lots of moving parts to a properly allocated portfolio. If you need some help, give us a call, send us an email, info@alhambrapartners.com.